Hello, everyone. Thank you very much for joining us once again today. Welcome back. We are discussing today business restructuring relief. We had already one session on the business restructuring relief. Now we are discussing the previous section. Along with this, we'll be discussing the critical aspects of the business restructuring relief. So business restructuring relief, just a recap of the previous all webinars. Till now, we have conducted around 56 webinars. And the last webinar that we had that we discussed the business restructuring relief. What is business restructuring relief? There are some certain conditions, and if the businesses are independent, part of the business is being transferred from the one taxable person to another taxable persons or to the potential taxable person as a result of this transfer, then the law allows us that the gains and loss on this transfer, it will not be subject to tax, but the transfer will be at the book value. What is the reason for this? Why it has been implemented? There are two major reasons for this. One of them is a going concern basis, because initially FTA was getting, assuming the FTA will be getting tax from party A, and after the transfer, they will be getting the tax from party B. This is a going concern. In both of the cases, business is paying relevant tax to the authorities. So this is the transfer as a going concern. So it will not have any impact on the taxation. So that business restructuring relief will not be subject to tax. This is the one factor. Second factor, government wanted to streamline, smooth, and make it easy the business transfer, merger, demerger, spin over, whatever the case is. So this is another reason for that business restructuring relief, that the transfer will not be subject to corporate tax. Then we have classified our discussion into three phases. These three phases were pre-transfer phase, transfer phase, and post-transfer phase. In this stages, we have class for discussion purpose. We say this is the one business, this business A, this business is being transferred to party. This is a assumed transferred. This is a transferee. There are some certain conditions before entering into these transactions. Before entering into this transaction, there are certain conditions. There's a criteria. This is called pre-trans. Like the law requires the taxable person should be, the transferor should be a taxable person. This is the first condition. Transferor business is being transferred to the taxable person or to the potential taxable person. Second condition. Then said that none of them is a qualifying free zone of the person. None of them is an exempt person. This is another condition. So independent business or the complete business is being transferred. There are two different conditions. One is 27A1 of the law. Second is 27(1)(b). In 27(1)(a) law says that the entire business or the independent part of the business is being transferred by the taxable person to another taxable person or to the potential taxable persons. In this, the transferor will not cease to exist. In the second category, they said entire business is being transferred by a person or group of persons to another taxable person or to the potential taxable persons. And in case of this transferor, the transferor will cease to exist. So these are some prerequisites to enter into to enjoy the business restructuring relief. This is the eligibility criteria. We are assuming that all eligibility criteria, like same financial layer, same accounting policies, none of them is qualifying free zone person, none of them is exempt persons. Both are taxable persons or the potential taxable person. Law requires there should be a resident taxable person or there should be an NP of the non-resident persons. So if all these conditions are being satisfied, now we are assuming, yes, they can go ahead and they can enjoy the business restructuring leave. But this is the eligibility criteria. To enter into this transaction, there are some certain other requirements as well. If the business has been transferred, now once the business is being transferred, entire business or independent part of the business. 27(1)(a) said entire or independent. 27(1)(b) says only entire business is being transferred. So now once the business is being transferred, they need to get the consideration. What should be the mode of consideration? Mode of consideration is that the transferor is getting equitable interest, equity or equitable interest. This equity or equitable interest they will be getting. This equity or equitable interest, it can be ordinary share, it can be preference share, it can be a redeemable preference share, or it can be any other equity interest. So that gives the powers to the transferor, two types of power. One, power to receive the profits. Second, power to receive, right to receive in the liquidation proceeds. Now this business, it should be 90%. Then there's one certain condition. They said this equity or equitable interest, other than this equity or equitable interest, the transferor can get cash or any other mode of consideration as well. But they said this cash or any other mode of consideration should be lower of what? Lower of net book value of assets and liabilities which are being transferred, or 10% of the interest that is being released by the transferee. Out of these two things, whatever is lower, cash or other type of consideration should be lower to both of these. So we can say the equity should be minimum 90%. Equity or equitable interest, it should be minimum 90%. Cash or any other mode of consideration, it can be maximum 10%. There should be a mode of consideration. Then another condition, this transferor or any other person who is holding transferor, or any other person who is holding at least 50% shares of the transferor, this person has right to receive the consideration from the transferee or any other person who is paying on behalf of them. Who can be the any other person who can pay on behalf of the transferee? They said the person, the payee will be transferee or any other person who is holding at least 50% interest in transferee. This person can make the payment on behalf of the transferee, and this payment, as we discussed earlier, maximum 90% can be in the form of cash or any other form of consideration, but 90%, 10% it will be cash or any other form of consideration, 90% it will be equity or equitable interest, that preference shares, ordinary shares, redeemable shares, any other document that will give a right to the transferor in the profits or in the liquidation proceeds. These are the other conditions that needs to be satisfied. Now we are assuming the business has been transferred. Eligibility criteria has been satisfied. Business has been transferred. Once the business has been transferred, there are some other requirements as well to remain eligible for the business restructuring relief. This is, we have covered this under the post-transfer phase. Under the post-transfer phase, that's with that clawback will not be triggered unless and until this business is being transferred within 2 years from the date of the transfer to a person who is not a part of the qualifying group member, or the shares of the transferor or the share of the transferee that are being resold. So if there are no any other changes like this within 2 years from the date of transfer, then clawback will not triggered. If any other changes are there, if any of the changes are there within 2 years from the date of transfer, then clawback will be triggered and the transferor will be liable to pay corporate tax by assuming this transaction has been executed at the market value, and transferor will be liable to pay the relevant corporate tax. And if the transferor ceases to exist as a transfer earlier, then transferee will be liable to pay tax on behalf of the transferor. So the relief, what was the relief in this whole situation? When this business was being transferred, they said this should be transferred at the net book value. If the market value is 100, net book value is 80, the business needs to be transferred at the 80. Once this business is being transferred at the 80, transferor will not book any gain or loss. This transferee will book the asset at the market value. Once the transferee will book the assets at the market value, transferee will charge the depreciation at the market value, but this depreciation will be disallowed to the extent initial gain at the time, that gain that was due, like this is 20, market value was net book value 80, market value 100, difference is 20. this depreciation will be disallowed here up to 20, remaining this will be allowed. So this was the basically overall structure where we said the businesses can enjoy the business restructuring relief if all these conditions have been satisfied. And we have classified the whole process into three different sections. These three different sections: pre-transfer phase, transfer phase, and post-transfer phase. In the pre-transfer phase, we discuss this is the taxable persons are the P of the non-resident person, entire business or the independent part of the business is being transferred, entire business or independent part of the business is a commercial sense is there, all legal formality has been satisfied. Transfer and transferee are resident persons or PEE of the non-resident person. None of them is exempt. None of them is a qualifying presumed person. They all have the same financial layer. Both have the same financial layer and both are applying the same accounting standards. These are prerequisite criteria, eligibility criteria. Then discuss if the business is being transferred, it should be transferred at the net book value. Net book value is equal to cost less accumulated depreciation. Might be there is a possibility that you're transferring the business during the year and you have already calculated the depreciation till the end of the last year. Then you need to calculate the depreciation for the remaining period. On the date of the transfer, what is the net book value? We need to arrive up to that value, net book value up to the date on the date of transfer. Then we discuss transfer phase. In the transfer phase, we discuss the value and consideration. They will discuss 27(1)(a), 27(1)(b). 1A says basically whatever the net assets and liabilities, whatever you are transferring, net assets less any other form of consideration other than equity or equitable interest, we need to deduct it. Remaining will be considered the value for the transfer. But if you are transferring under 27(1)(b), because here you are surrendering the share and the transferor will cease to exist, so they are asking what are the value of the shares and equitable interest that you are surrendering less any other form of consideration that you have received, it will be considered the value of the transfer. The consideration we discuss, it should be in the form of shares or equitable interest or other and any other form of consideration. Shares and equitable interest, we said it should be minimum 90% cash, and any other form of consideration, it can be maximum 10%. So the payee can be transferee or any other person who is holding at least 50% rights in transferee. Then, and this thing is very important, any other person who is holding 50% in this is a transferor, this is a transferee. The person who is holding at least 50% in the transferee, this person cannot be a natural person. Keep in mind, this is very important. This person cannot be natural person. What is the reason for this? Because the law requires at least 90% consideration should be in the form of shares or equitable interest. So natural person cannot hold any equity or equitable interest. So definitely there will be a legal person. So transferor can be any person. Any transferor can be taxable person, but the person who is holding at least 50% share of the transferor, that person can be a natural person as well. Then discuss transfer of business without any profit or loss. It should be transferred at the net book value, and there will not be any gain, any loss on the date of transfer in the books of the transferor. Unutilized losses will be transferred as well, subject to the condition the transfer is conducting the similar business. Unutilized losses of the transferor will be transferred to the transferee, but any interest, net interest expenditure will not be transferred from the transferor to the transferee. It will remain with the transferor. Clawback criteria we have discussed. Clawback criteria, we discussed the two possibilities. Once the business has been transferred within 2 years from the date of transfer, two things can arise. Once, whatever the business has been transferred, this is a business transfer to transferee. Transferee can transfer this business within 2 years to any other person. If the transferee is transferring, selling, disposing of the business, any part of it or any independent part of it, important, business or any independent part of it, if the transfer is further transferring within 2 years from the date of transfer, then clawback will be triggered and these benefits will not be given to the taxable persons, and transferor will be liable to pay tax on the market value. The second possibility is the equity interest that has been issued by the transferee or any other person who is holding at least 50% interest in the transferee. If this equity interest, it has been sold, even a single share has been sold, transferred or disposed of within 1 year from the date of transfer, then clawback will be triggered. We'll look into the guide as well. This was the basically whatever we have discussed in our previous webinars. So in this all discussion, why I have specifically written and speaking about the critical aspects of the business restructuring relief. This is important. There are some tiny points which are very important. We need to look into this. These tiny points are conditions should be tested in the same tax period. This is important. We'll discuss the eligibility criteria and conditions, transfer phase conditions. All these conditions needs to be tested in the relevant tax period, in the relevant period, basically, whenever we are transferring the business. Before that, what has happened, it doesn't matter. And after that, what has happened, it doesn't matter. But we need to test the condition when this business is being transferred. Is important. Second, taxable resident person, a PE of the non-resident person. Transferor and transferee can be taxable resident person. This is important. Taxable resident persons or PE of the non-resident person. So this thing is very clear. Non-resident businesses, they cannot enjoy the business restructuring relief. First. Second, now the resident business can be classified into two categories. These are the exempt businesses and taxable businesses. So exempt businesses cannot enjoy the business restructuring relief as well, because this is only applicable for the taxable persons. So exempt businesses, they will not be able to enjoy the business restructuring relief. The business restructuring relief is only taxable person. These taxable persons can be natural persons and this can be juridical person. Both of the parties, even natural taxable person, even juridical taxable person, both of the parties can enjoy the business restructuring relief. Exempt businesses and non-resident businesses cannot enjoy. PE, yes, PE of the non-resident person can enjoy the business restructuring relief. Even there is a transaction from one PE to another PE, at the end, both are taxable persons. So both of the parties, still business restructuring relief will be applicable. If there is a natural person, having a natural person revenue is up to 1 million, natural person will not be considered a taxable person. So natural person will not be able to enjoy the business restructuring relief. So government entities, business involved in the extraction of natural resources, business involved in the supporting function extraction of natural resources, different types of funds, qualifying public welfare entities, semi-government entities, these all persons, these are the exempt persons from the federal UAE corporate tax. So these persons will not be able to enjoy the business restructuring relief. Now, transferee must not be a qualifying free zone person and exempt person. But keep in mind, this transferor and transferee should not be a qualifying free zone person and exempt persons at the time of transfer. There is a possibility that this is the transferor, this is the transferee, this transferor, this transferee. At the time of transfer, this was taxable person, this was taxable person, or potential taxable person. After the date of transfer, this transferor, which was the taxable person, it has become a qualifying free zone person, or it has become exempt person, or this transferee has become qualifying free zone person or exempt person. In both of the cases, clawback will not be triggered. Business restructuring relief will prevail. Same fiscal year. Whenever we are asking the same fiscal year, two things are very important: start date and end date. It has been written in the guide. It doesn't matter what is the start date of the fiscal year. The important thing is both of the parties have the same ending of the financial year. Whenever the financial, might be one party has a fiscal year of 6 months, other party has fiscal year of 12 months. This 6 months, this 12 months. When this 6 months is starting, when this 12 months is starting, this is not relevant. Important thing is both are ending on the same date. If both are ending on the same date, then we'll assume they have the same ending of the fiscal year. Consistent accounting policies. Both of the entities, transferor and transferee, they must have the consistent accounting policies. Consistent accounting policies means we know there are different bases. There is a cash basis, accrual basis. Under the accrual basis, then there is the full-fledged IFRS for SMEs. There are different IFRS, full-fledged IFRS SMEs, cash basis of accounting, accrual basis of accounting. Whatever the method, whatever the pattern they are following, they need, both of the parties needs to follow the same pattern if they wanted to enjoy the business restructuring relief. Assuming if one entity is applying full-fledged IFRS, second entity must apply the full-fledged IFRS. There is a possibility entity A transfer is applying full-fledged IFRS, but the entity is by applying IFRS for SMEs. Then for tax purposes, they can prepare the financial on based upon the full-fledged IFRS. They will apple to apple comparison, then they will be able to enjoy the business restructuring relief. Depreciation will be disallowed to the transferee up to the initial gain, and that was not initial gain or loss as well. If there was initial loss, it has been written in the guide. So whatever the depreciation, as we said, market value was 100, book value was 80, difference is 20. This 20 will not be booked by the transferor at the time of transfer, so it will be gain. Transfer will be at 80. Once the transfer will be at 80, transferee will charge the depreciation on 100. While charging a depreciation, this 20 will be disallowed. This 20 depreciation up to 20 will be disallowed, and it will be allowed at the time of recognition, at the transfer of the asset. We'll look into the guide. Then to be evaluated in respect of each business restructuring transaction, we need to apply the BRR on not oral basis, basically transaction by transaction basis. Independent part of the business and support function. What is independent part of the business support function? Independent part of the business means that any business that can operate independently. So this is the full-fledged one comprehensive where the multiple divisions are inside. One division is being transferred. It will be considered independent part of the business if this division can operate independently and function independently. Even the law guide said if the support functions are being performed by the central team like centralized HR, corporate HR, corporate IT, corporate finance functions, corporate accounting functions. If all these support is being provided by a corporate level, still from the transferor, still it will be considered independent part of the business. So transfer at book value prevailing at the date of transfer, we have already discussed this point. Then clawback will trigger even a single share has been transferred out of the ownership interest. These two things are important. One, even a single share is being transferred. If you are, and this shares and out of the ownership interest issued. Assuming this is a transferor, this is a transferee has issued 20 shares to the transferor was already holding 80 shares, assuming. So out of this 20, if any single share is being transferred, then clawback will be triggered. If out of 80 any shares are being transferred, then clawback will not trigger. So important thing is even a single share is being transferred out of the equity interest shares that has been issued as a result of the transfer, then clawback will be triggered. Otherwise, clawback will not be triggered. So these were some important things I have covered in my slides as well. We can go through quickly. The guide, I believe, then we'll be in a better position to understand it. Okay, then you can see here, entire business is being transferred or independent part of the business is being transferred. Here, entire business is being transferred. Share or ownership interest, this is same for both of the cases. Part of consideration may be in the form of cash or any other equitable interest. We have already discussed. Consideration can be received by a transferee or any other person who is holding at least 50% share of the transferor and transferee. We have already discussed. Consideration paid, payee and transfer we can discuss. We have already discussed. Examples of business restructuring relief covered. These are the examples. Basically, natural person convert itself into a sole proprietorship. Unincorporated partnership, here there will not be any consideration. This is very important because whenever the owners are members of the unincorporated partnership are requesting FTA to transfer this partnership into a taxable person, there will not be any consideration. But other than this case, consideration is compulsory. If there is no consideration, then the businesses will not be able to enjoy the business restructuring relief. Transaction in the form of transfer entire business to another third party, legal merger, you can look into the, here you can see transferor was there. Business X, business Y, transferor has transferred business Y to this transferee. Then after this got a consideration in the form of share, yes, they can enjoy the business restructuring relief subject to the condition that all other conditions are being satisfied. In the same way, transferor has transferred its own business to a transferee 100% owned subsidiary that got additional shares from the transferee. Yes, they can enjoy the business restructuring relief. Here the part subsidiary here 50%. After the transfer is enjoying 75%. If all other conditions are being satisfied, then transfer can enjoy the business restructuring relief. Example where 27(1)(b) we have already discussed. 27(1)(b) transferor will cease to exist. Entire business is being transferred, and transferor can be one or more taxable person. You can look into the example. Parent company transfer is business to this transferee, and this transfer ceases to exist. So yes, this will be considered business restructuring relief. In the same way, this transferor, this is a parent company, the transferor, this business has been transferred to transferee 1, 2. This business itself ceases to exist. Yes, they can enjoy the business restructuring relief. These are the some examples which will not be covered under the business restructuring relief. Liquidation will not be considered business restructuring relief. Along with this, if the business is being transferred without any consideration, one exception is there, which was that unincorporated partnership is being converted into the LLC or taxable person. Other than this, consideration should be there. If there no consideration, so it will not fall under the scope of business restructuring relief, and the taxable person and the parties will not be able to enjoy the business restructuring relief. Meaning of the business or independent part of the business, we have already discussed, operated independently and separately. Then we discuss even this support function is being performed by the transferor, and business can operate independently and the business can operate separately, still being supported by the transferor. In this support function, as I mentioned, this is technology, the accounts department, technology, human resource, then still it will be considered a independent business, and business restructuring relief can be applied, but this will be only applicable in case of 27(1)(a), 27(1)(b), it will not be applicable. Consideration of transfer, we have already discussed. The consideration should be in the form of equitable interest, but other than equity and equitable interest, maximum 10% can be in the form of cash or any other form. Equity or equitable interest were discussed. This consideration transferee, the transferee can be. Can you look into this example? Basically, the business has been transferred to under B. B is making the payment to a party who is holding to the transferor 100%. This party, the person who is holding 100% equity in the transferor, this party can be independent, natural person or juridical person in the UAE, out of the UAE, it doesn't matter wherever is this party, still business restructuring relief will be applicable. But in case of transferee, the person who is paying on behalf of the transferee, who is holding at least 50% interest in the transferee, that person must be should not be a natural person, because this person needs to issue the equitable interest or equity at least 90%. Payer and issuer of consideration we have discussed. Again, this you can look into this. Now, business is being transferred from this Y to B, but payment is being made to a party who is outside the UAE on behalf of D, B to a party on behalf of A. So this person is holding 100%. This person is also holding 100% in the transferor. This person is holding 100% in transferee. It doesn't matter in the UAE, out of the UAE, but important thing is who is paying on behalf of the transferee, the person. They need to issue at least 50%, sorry, at least 90% in the equity or equitable interest. This person cannot be natural person, as we discussed earlier. Form of consideration, it should be equity or equitable interest, but maximum 10% in the form of cash or any other form of consideration other than equitable interest. Equity or equitable interest, it can be in the form of ordinary shares, preference share, redeemable preference share, or any other document that gives the authority to the transferor that the transferor can receive the profits or liquidation proceeds. So the person should be a holder, transferor should be a holder. When it will be considered holder, there's a two condition needs to be satisfied. Controlled by the taxable person, right to receive economic benefit in the form of profits and equitable interest. When it will be considered controlled by the taxable person, they said when the transferor has power over the investee, and when the transferor exposure and rights are variable getting returns and ability to use its power. These conditions are for the person. If the person is having these conditions, it will be considered control. The person has a control and when it will consider control, that person will be holding ownership interest where the following two conditions are being satisfied. You can look into this other form of consideration. This is very important. We have discussed it should not be more than 10% in the form of cash or any other form of consideration which is not equitable interest. 90% max, minimum 90% should be in the form of equity or equitable interest. Just look into this example. A and B are companies incorporated and resident in the UAE and who use the Gregorian calendar year as their financial year and tax period. On 1st July 2024, company A transferred all of its business to B in exchange for shares in B with a nominal value of 6 million. So what are the exchange for shares? Shares have a nominal value of 6 million and a cash payment of 0.5 million. Cash payment is 0.5 million. We have already discussed it should not be more than what? It should not be more than lower of both. Lower of what? Lower of the net book value of the assets and liabilities which are being transferred, or 10% of the interest which has been released by the transferee. Out of these two, whichever is lower, this consideration should not be more than that. So net book, the consideration that is being paid by the transferee in the form of shares is 6 million. Cash is being received 0.5 million. Net book value is 6.5 million. So lower of 6.5 million or lower of 6 million. So 6.5 million or 10% of 6 million, whichever is lower, the lower is 0.6 million. This principally cash should not be more than 0.6 million, and that is not more than 6 million. So it means this condition has been satisfied. The businesses can enjoy the restructuring relief. There is a consideration of 0.5 million less than 0.6 million because business restructuring relief is permitted in this case. If this cash would have been more than 0.6 million, then business restructuring relief would have not been permitted. Situation where there no consideration, we have already discussed when this basically unincorporated partnership is being requested by the partner to the FTA and FTA transfer, converting this unincorporated partnership into a taxable person, then consideration will not be there. Conditions to qualify business restructuring relief, we again and again we will discuss. It should be legislation of the UAE, but if this transfer is subject to any international or foreign law, still it will be fine. But this foreign law or local law or international law, whatever the laws are applicable under this transaction, all the related laws needs to be respected and all related conditions needs to be fulfilled. Means this transaction needs to be exactly as per the local law, or if applicable international law is applicable, it should be as per the requirement of the international law. Then resident and PE of the non-resident person, we have already discussed. Exempt person we discussed. Qualifying for reason person discussed. Same financial year, same accounting policy. Commercial sense should be there as well. If there no commercial sense, then you cannot enjoy the business restructuring relief. Legally compliant condition we have already discussed. Can you see? They are asking if the foreign law is applicable, still you can enjoy the business restructuring relief, but you need to satisfy the requirement of the foreign law. Taxable person's condition, it should be a resident taxable person, a PE of the non-resident person. Important, one PE in the UAE to another PE. If the transaction is being made from one PE to another PE within the UAE, still you can enjoy the business restructuring relief subject to the condition. All other conditions are being satisfied. PE in the UAE and the head office since the PE, if there is a branch and head office, legally there is no difference in between the parent company and branch. Branch itself has no legal status. This is directly associated with the parent company. If there is any transaction in between the branch and the parent company, so you will not be able to enjoy the business restructuring relief because it will be considered a transfer within the same company. There's no difference, as I mentioned, in between the branch and the parent company. Even you can see in the VAT law as well, whenever any branch which is out of the UAE and the parent company within the UAE, or the parent company is out of the UAE, branch is within the UAE, if there is any transaction, there is no legal requirement to issue the tax invoice, but debit notes are debit notes are sufficient. Even the UAE law doesn't allow you to issue the debit note. The law allows you, VAT law asks you to issue a tax invoice, but if there is a parent company and branch, There are no difference in between the company. Even this is in the UAE or out of the UAE, you can issue the debit notes. So in the same thing is applicable here as well. If there's a parent company and a branch, if there's any transaction in between the parent company, one is transfer, other is transferee, then you cannot enjoy the business restructuring relief because this is basically transfer within the same entity. Exempt person condition, we already discussed this. Exempt person at the time of transfer, they should not be exempt person. After this, they can become exempt person. Still, business restructuring relief will be applicable. Same financial year, we have already discussed in detail. By the way, you can change the financial year, and there is one cabinet decision on this. You can go through the cabinet decision, but maximum you can go up to 18 months, I think, minimum up to 6 months. Yes, it has been written here as well. So you can go up to 18 months, 6 months. You can change the financial year, but before the submission of the return, there's some certain requirement. You can go through this. You can basically streamline your financial year to enjoy the business restructuring relief benefits, but it should have the same ending. It doesn't matter whenever the financial period are starting, ending should be same. Accounting standard condition, we already discussed this. Valid commercial reason, yes. Now the consequences of electing for small business relief. We have already discussed so many times. This business restructuring relief is an optional tool. This is not a compulsory. If you're not opting for business restructuring relief, you cannot enjoy the benefits of business restructuring relief. So if you have opted this and all the related conditions are being satisfied, then you need to transfer the asset and liability at the book value, not at the market value. Just look into this example. Here you can see the net book value is 2.3 million. Market value is 2.7 million. The asset has been transferred. Amount of consideration deemed to have been received from corporate tax purposes 2.3 million. Net book value 2.3 million. No gain, no loss. How to determine the net book value? We have already discussed. We need to discuss cost less accumulated depreciation. Accumulated depreciation we need to take till the date of transfer. Adjustment to be made by the transferee. This is important. Now the business has been transferred from the transferor to the transferee. Transferor will adjust at the book value. Transferee will book at the market value. So when the transferee will charge the depreciation at the market value as well. They said this transferee will not be allowed the depreciation up to the gain or losses initially at the time of transfer. And when this upon realization of the assets and liabilities, again it will be adjusted. Look into this. To exclude depreciation, in case other than upon realization, asset has been transferred from the transferor to the transferee, but it has not been for the realization. It has not been, still transferee is holding the asset. To exclude depreciation and amortization, other change in the value of the transferred asset and liabilities to the extent that they have been able to gain or loss around the transfer and was not recognized at the time of transfer. Whatever the gain, whatever is the loss which was not recognized, depreciation will be disallowed up to that value. So basically, if you look into this, the gain that was supposed to be subject to tax at the time of transfer, that gain has been disallowed to the transferee. It will increase the taxable income of the transferee. This gain on which tax was applicable at the time of transfer, now the same amount will be disallowed to the transferee. Transferee taxable profit will go up and transferee will be paying more tax. This is just a timing difference. And realization, we need to make adjustment as well. We look into the example. Just look into this example. It will clarify a lot of things. Company A and Company B are companies incorporated and resident in the UAE and both use the same Gregorian calendar year, which is 31st December as their financial year and tax period. Company A conducts business in the UAE in all assets and net book value of 20 million, with 10 million released to immovable property with net book value of 10 million. On 31st December 2024, Company A transferred its business to Company B at a market value of 30 million in exchange for shares issued by the Company B. Company A transferred its business to Company B at net book value of 30 million. Okay. The market value of the immovable property is 12 million. So business has been transferred at 30 million. The market value of immovable property 10 million. Book value immovable property is 10 million. Market value 12 million. For corporate tax purpose, the company elects to apply the business restructuring relief. According to the company is treated as the transferring asset 20 million for corporate tax purposes, so will not include the gain of 10 million in its taxable income. So net book value was 20 million, market value of 30 million, business has been transferred 30 to 20 million. So 10 million gain has not been booked. Keep in mind, business has been transferred at the net book value to enjoy the business restructuring relief. In the books of B, the immovable property, specifically for the immovable property, opening net book value 12 million. This is the market value. B is the transferee, keep in mind. B is booking at 12 million, not at 10 million. So how much is the depreciation? Assuming this has been depreciated over the period of 10 years. 1.2 million, 10 years, 1.2, 1.2, 1.2. Closing net book value 10.8, 9.6, 8.4. Now if you look into the depreciation, how much is the depreciation? 1.2, 1.2, 1.2. You can look into this. This is the depreciation. 1.2 is depreciation. How much has been disallowed? It should be disallowed up to the gain, initial gain. How much was the initial gain? 12 million and 10 million. 2 million. 2 million was the gain at the time of transfer, but this gain has not been booked by the transferor because they wanted to enjoy the business restructuring relief and they have opted for this. So this 12 million, 2 million, sorry, in the difference between 10 and 12, it has been disallowed here. Can you see? In the first year, full depreciation has been disallowed. So once the depreciation has been disallowed, means the taxable profit of the transferee will go up by 1.2 million. The transferee will be liable to pay more tax. Then 1.28 million is the balancing number. Total maximum depreciation needs to be disallowed is 2 million. 0.8 million again it has been disallowed. So total disallowed amount is 2 million. 2 million, transferor has not paid tax. Transferee will pay tax because depreciation has been disallowed to the transferee up to 2 million and transferee will pay extra tax up to 2 million. Then they started allowing depreciation. Okay, now they said this treatment, the treatment till now, till this treatment is that the asset has not been realized. Now the asset has been realized. They are asking you need to make one more adjustment at the time of transfer, realization of the asset. In 2027, company B sells the immovable property to a third party. Means this event has occurred, what has been written in the guide. Upon realization of the asset and liability, now the asset is being realized in 2027. Then what you need to do, you need to make another adjustment. Whatever the gain you need to adjust, depreciation need to adjust, sale proceeds and book value you need to adjust, remaining will be a taxable income. So it has been exactly written here. You can look into this. To include any amount of depreciation, amortization, other change in the value of the transferred asset and liability that have not been recognized for corporate tax purposes under the applicable, not recognized for corporate tax purposes, you need to adjust it back. Realization includes sale proceeds. This now, if you are going into this, B will include gain of 2 million that arose to 2 million. Then they will adjust 2 million depreciation. Then they need to sale proceed and book value. Remaining will be the amount on which they will be liable to pay any tax. So this is how basically, if you are looking into this very carefully, you can look into this. The burden of paying tax has been transferred under the business restructuring relief from the transferor to the transferee. Transferor was supposed to pay the tax at the time of transfer in a single go, but the transferee is paying the tax up to the disallowance of the depreciation. At the end, FT is getting the full amount, by the way. Then once this business is being transferred, once this asset or liability or the business is being transferred, then they're making the adjustment and paying the related tax upon that as well. If there are multiple transfer, they're asking you need to make adjustment for all assets. You can go through these examples of multiple transfer. Value of shares, and we've already discussed value of shares and ownership interest. If this is where 27, 1A is applicable, net book value of the asset and liability is given, less net amount of any other consideration received. It should be the value of equitable interest that has been received from the transferee or any other person who is paying on behalf of the transferee. Just look into this example. A and B are companies incorporated and resident in the UAE to use the Gregorian calendar year as the financial year and tax period. On 1st July 2024, company transferred all of its businesses to company B. in exchange for shares in company B with a nominal value of 6 million, cash 0.5 million, net book value is 6.5 million, marketable asset and liability is 10% already discussed, 10 million. Now you can look into this. Net book value of the asset and liabilities is 6.5 million less 0.5 million. We already discussed. The value of the equity or equitable interest or shares the transferor or any other person on behalf of the transferor has received is 6 million. But if where the 27(1)(b) is applicable, then we need to assess the value of the shares and equitable interest that is being surrendered by the transferor, less the net book value of the cash or any other form of consideration received. That will be considered the net book value of the, that will be considered the market value of the equity or any other form of equitable interest received from the transferee or any other person who is paying on behalf of the transferee. Transfer of losses we have already discussed. Clawback. For the clawback, I think we can discuss in our next webinar, or you can go through the various examples are there, the clawback examples are there, the condition we already told you. If from this is a basically post-transfer phase, within 2 years from the date of transfer, whatever the business has been transferred, that business or independent part of that business has not been transferred, sold or disposed of, one, or there is a possibility that the shares or equitable interest that has been issued might be their holding in the transfer or might be their holding in the transferee. So some even a single share of that consideration which has been paid in the form of shares or equitable interest, if it has been transferred, sold or disposed of within 2 years from the date of transfer, then clawback will trigger. You can look into this. Transfer of shares in the transfer or transferee, they said only in respect of those shares and ownership interest that were issued by the transfer or transferee as not part business restructuring relief. I've already given you an example. If the transferor is already holding 80%, now 20% more shares in case of this transfer are being issued to the transferor. So this condition is only applicable on the 20% shares, not on the remaining 80% shares. Now there is a possibility this 20% shares, you can identify this 20% share. There is a possibility that you cannot identify this 20% shares. How can you identify? Might be each share is a serially numbered. So if they are asking if this share is serially numbered, then you will be able to very easily identify, which will be very easily identifiable. The remaining 80% of if these shares are not numbered, then they are asking you need to look into the FIFO method, first in, first out method. They have covered it here. So the important thing is this will be only applicable on the equitable interest that has been issued as a result of this transfer. You can look into this example. Company A and B and C are companies incorporated and resident in the UAE and who use the Gregorian calendar year as their financial period and tax period. Company B holds 100% of the shares in company C. A, B, and C are there. B is holding 100% shares in C. B is holding 100% shares in C. Company A transferred all her business to C in exchange for the share representing an ownership of 20% C. The remaining 80% of the shares in C continue to be held by company B. Now, initially, it was B was holding C 100%. Now, 80% is being held by B, 20% is being held by A. Now, if this 80% share, any share is being transferred out of the 80% which is being held by C, the clawback will not trigger. And if even a single share has been sold, disposed of, transferred, whatever is the case, the share that is being held by A, because the A is holding this share as a result of the transfer, then clawback will trigger. So they have mentioned here, business restructuring relief will be clawed back if the shares in the transfer were issued as a part of business restructuring are wholly or partly transferred within 2 years. These shares were not, so to a person is not a qualifying person. In this case, B transferred its shares in the transferee to a third party. B transfer, not A. B transfer, B was already holding this share before the transfer. So these shares were not issued as a result of the business restructuring relief, so clawback will not be triggered. Situation where transfer of shares will trigger clawback, where when you are selling the shares, when the company transfer as a liquidation, as a result of liquidation or winding up, you are surrendering the share. These shares are being used to acquire another business. So these are different possibilities. In whole or in part, we discuss in serial number or FIFO if you cannot identify the serial number. Okay, various examples are there. You can go through all those examples. I think this is over from my side, the business restructuring relief. If you have any questions specifically, you can drop me an email. You can give me a call as well. I will always be there to support you. If you are any need of any support, please let me know. So I will upload this lecture on a YouTube channel. You can download it from there. You can view it. If you have any question, you are most welcome. Oh, yes. Take care. Thank you very much. Have a lovely evening. Thank you. Bye-bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.